You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to Wealth Formula Podcast. And of course, today is the show on Wednesday where we go through the markets with Zulfe Ali, who is with Valerity Wealth. Valerity Wealth caters to investors who make a little bit more money, who are looking for maybe more of a family office type situation. Zulfe, how are you today?
I'm doing great, Buck. Good to be back.
All right. Well, why don't we start with this? A little commentary on last week's show. We talked about housing challenges.
Housing shortage seems to be a pretty big issue and becoming part of the Harris campaign in particular, talking about all these initiatives and stuff. Interestingly enough, I mean, it's not a new issue. I mean, it really kind of came about as a result of the financial crisis back in 2007, 2008. If you remember, Buck, just before that, and I think it was actually during Clinton's presidency, where as an effort to help those folks that were kind of already priced out of the housing market, there were some regulations that were loosened and loans became easier to get. You had the onset of subprime as a major category. You had loan structures that were becoming more and more aggressive so that the borrowers can make payments. So you had like interest-only payments, for example, for periods of times, and other types of structures as well. So what that all did was, it just kind of fueled this housing bubble at that point, running right up to kind of 2006, 2007. And ultimately, there was a collapse when the loans that were, taken out from, in those situations that probably should never have been made, when those loans started defaulting, and then the securities that were collateralized by those loans started to basically unwind themselves. You had a lot of institutions that, saw the pain and suffering, and Lehman Brothers obviously is the big example, but there was no shortage of, a lot of losses across a lot of big institutions that held those types of securities and instruments on their balance sheet. So really, it was kind of the post 2007, 2008 financial crisis that all of a sudden, we went from building 2.2 million homed units per year. That collapsed down to like 600, 700 units per year for the, immediate several years after 2008. And then, ever since then, it's slowly come back, but you're talking about, I think the latest data we have is it's about 1.5 million new homes per year. And again, if you compare that to 2.2, which was kind of meeting the annual growth way back in 2004, 2005. So there's just been this kind of decade plus of undersupply, and it's becoming very acute. And that's the challenge. A lot of the new home builders went out of business. A lot of the infrastructure was just gone in terms of, building new homes. And as you saw some of the recovery over the last decade, home builders have kind of tended to focus on larger homes that are more expensive, that are more profitable, obviously, and kind of not really gone into the smaller single family homes as much, just because it's not as profitable and that sort of thing. So,
well, obviously, those kinds of, housing shortages have been a tremendous benefit for people like me who have been in this kind of rental market as multifamily rental markets. Let's talk specifically about, some of the ways that our guest suggested to solve some of this. We talked about some of the regulatory things and things like that. Love your feedback.
I mean, I think, listen, at the end of the day, the issues that we've got, so we're short about 2 to 3 million units, home units, right, in the U.S. And that's really a supply issue. So I'm kind of, viewing as suspect anything kind of significant that is done to help demand. Like, it doesn't make sense to me that, we're gonna come up with subsidies or lending programs to help buyers. Either that's going to address the housing issue in any form, because all that's just going to do is create more demand, right? And potentially drive the cost of housing even higher. where it might make sense, where it probably makes sense is for the government to reduce some regulatory hurdles. So maybe there's, zoning restrictions that could be relaxed. Maybe there's environmental restrictions in certain areas that need to be relaxed. There's probably a variety of kind of just regulatory things that the government can do to allow, more building, more rapid building, and that sort of thing. And then, my thought is that you probably want to pump more, subsidy. If anybody gets subsidy, I think it should go to the developers. I think they're the ones
Yeah.
that need the incentive to build the houses targeting middle class. If you give it to the buyers, everyone else is going to profit except for the buyer because the prices are going to go right up by that amount.
Yeah.
So,
And that's one of the things I brought up. And I was actually, obviously he's, I didn't agree with him on a lot of stuff, but I was happy to hear that he didn't think the Harris idea of credits at closing for buyers was a good idea. I mean, it just sounds crazy, right? I mean, like all of a sudden, all that's going to happen is, what was it? What's the suggest, like $20,000 at closing or something like that? Isn't that what they're suggesting? The Harris administration.
I think that's right.
Yeah.
Yeah.
I mean, all that's going to do is it's going to drive up costs by $20,000. I mean, it's just
exactly.
I mean, it's
but again, it doesn't solve anything. There's no homes for those folks to buy. That's the fundamental issue, right? Is that
it just makes it even more expensive. The markets. I mean, because one of the reasons they can't also is because the housing costs are a problem, and it's not only just houses to buy, but rentals, right? And if you remember our conversation, one thing that I really couldn't figure out what he was getting at was this whole idea that somehow you were going to be able to intervene with various software that landlords use in order to figure out what rent should be. That sounded downright ludicrous to me. Like, I don't know how you're going to, I get the idea of sort of trying to stop like a monopoly type situation when there's data out there to say that you're going to intervene in whatever software's ability to gather that data and give you guidance is just incredible. I mean, I don't know how in the world you'd do that. Or
I know. Yeah, I kind of got the sense he wasn't quite as knowledgeable on that particular topic as he kind of threw it out there. Because when you pushed him on it a bit, he was like, "Well, there's a lot we need to learn yet, right?" So I think he kind of threw it out there. I'm with you. I'm like, it doesn't matter whether you do it with software or algorithms, or if you've got a team of people walking down and checking out all the properties and what they cost, and you come back and you come up with a price, a rate for your rent that takes into account all the properties that are around you. Why does it matter if you do it through a software algorithm? I think, at the end of the day, I think the question is there some system that's allowing landlords to collude, right? Are they acting like a monopoly, like you said, which is they're basically saying, hey, guys, forget the market dynamics. Let's all set the price right here and no one budge, right? And that okay, I get that, but I don't.
But that's not really.
Think,
that's not what's happening. It's not like people sit there and talk to each other. I mean, you might as well go. The analogy is like if you're going to sell something on Amazon, you're going to go see what other people are selling. The same thing for, and to make sure that you're competitive and that you're getting the most out of it. And then it becomes maybe a quality issue. You're not really worried about that you're charging even too much. It's as much that you're charging too much as it is you're charging too little. And so anyway, to me, that was like, again, it was starting to get into, kind of silly stuff. I was actually generally kind of pleasantly surprised because like I think he's a pretty liberal guy, that he called out certain things as just simply not things that would work. Like, for example, price controls in rents. He called it for what it was, which was a complete, like, it's a stupid idea. It's not good for neighborhoods. It's not good for, why would people build housing if they're not going to be able to make money from it? All right, well, let's move on to other things. Let's talk about the financial markets.
Sure. Well, we had a big surprise at the end of last week. We had the jobs report that came out. We were expecting new jobs of about 150,000. Ended up being 254,000 new jobs added in the month of September. So that was a big upside surprise. The unemployment rate actually ticked down to 4.1% from 4.2%, which was the case for the prior, couple of months. I think it really caught the markets by surprise. There was just this increasing worry that the jobs market, that the labor market is unwinding very quickly. And that's what led a lot of the markets to anticipate, and correctly anticipate, that the Fed would cut by 50 basis points when it did a few weeks ago. And I think investors had already built in hopes or expectations that, despite the fact that the Fed chairman said 25 basis points for the next two meetings is likely, I think investors were already assuming that, there could be a very good chance of another 15 basis points Fed cut coming up, especially if the labor market showed more and more deterioration. So that was very surprising.
It is a huge surprise, right? But then again, I mean, how many times have they corrected and it's been lower? Do you think that based on those numbers that there's any possibility? I mean, I guess the next meeting is what, after the election, right? Or is there one before?
That's right.
Yeah.
No, it's just after.
I wonder if there's a possibility that they don't cut because of this. What do you think?
I think by them starting their rate cutting cycle signaled that they believe that this, imaginary or theoretical neutral rate is much lower than what we're at today. And so they want to get to that neutral rate. And I think they have a bias to cut, and that's how they start a cycle. They never start a cycle saying we need one cut, and that's it. Now, a lot could happen between now and then, but the problem is that you're probably going to have a lot of noise in the data coming up for the next month. For example, with the hurricane, with the two hurricanes, actually with the one that's coming up now with Milton, I mean, that's just going to throw a lot of stats and numbers kind of to the side, because it's just not going to be clean measurements coming up for when you have several states that will be caught up in all this stuff. Thankfully, we didn't have the dock workers, the strike that they were talking about. That could still happen. I think it's on pause right now because they got the increase in wages they want.
What's that all about? I didn't even know about that. Maybe you should.
It's an increase in wages. It's the port workers, the workers at all the ports. It's a huge potential issue, because you're talking about the eastern, all the eastern ports are under union, and they were threatening to go on strike. They were literally going to go out. That would have caused a huge.
That's like everything from Europe, right? I mean, basically
everything from everywhere coming outside of the U.S. into the East Coast. So you're talking Europe and a lot of, the Caribbean. Think about bananas, think about, sugar, think about, stuff coming from there. It's Europe and elsewhere. So it would have been really bad timing, as stores are stocking up on holiday, retail sales and all that kind of stuff for the end of the year. But fortunately, that has been sidelined for the moment, in the sense that they got the wages that they were looking for. They got that agreement, but I think there's some other non-wage related items that they are working through. But it seems like they'll work through it, so that's good. So that's one risk kind of mitigated for the time being. And of course, you've got the Middle East completely looking like it's going to go off the rails, and we'll have to see how that kind of plays out. So that's another potential risk there. So my point being, I think there's enough kind of, exogenous events that it's going to be hard to get a real good reading on the data. And I think the Fed's probably going to just keep moving forward with its 25 basis points cuts going forward, at least for the next two. I can't imagine that they'll do anything dramatically different than that.
Yeah.
But obviously they're taking a wait and see approach on all this kind of stuff. The stock markets loved the labor report because that just affirmed the view. And we talked about this before. The stock market has been kind of painting the optimistic picture of a very soft landing and back into a nice economic growth scenario. Well, this helps kind of buttress that thought process, which is, look, we're not losing that many jobs. We're not going to head into some terrible recession, and so
And
the stock market has
at the
reacted really
same
well.
time, I guess if you look at it from, I'm trying to figure out, like why it's so positive. I guess it's because at the same time that you have labor showing strength, you have, you don't have inflation going up.
That's right.
But
Yeah, inflation is contained, and so we're really not as worried about that. And I think again the housing component of inflation, as you mentioned before too, is lagging. So we know that's still coming through, and that should help keep inflation nice and controlled. And there's no reason to assume that there's any dramatic effect here. Even with Middle East issues, oil prices are likely to stay kind of range bound, just because the amount, like let's say the worst scenario here is that Israel does something to disrupt or destroy Iran's oil production. Well, they're not that huge of a player. They're meaningful, but not a lot, and it's not coming this way anyway. I mean, we don't buy, and a lot of the Western world does not buy Iranian oil, and Saudi can pretty much increase its taps to overcome any kind of shutdown that might come from that. So you're seeing that the oil markets, in fact, even today, I think oil is down like 4% or something like that. But you're seeing that, oil has been kind of volatile, but it's been pretty range bound. It's not shooting up like $100 a barrel kind of stuff. So that risk of inflation kind of feeding through oil is not necessarily there. You've got all these other things that might weaken the economy, whether it's hurricane effects and that kind of stuff.
Although I will say this, that labor's a big part of inflation, isn't it? I mean,
it is.
Yeah, I mean,
it is, but what we're not seeing is a huge amount of wage growth, right? So this is showing that employment
number of jobs.
Yeah, number of jobs is a nice healthy clip. We're not losing a bunch of jobs. And what that does is also make us feel good that, people that are employed are going to spend as you go into the holiday season. Consumer spending is, 2/3 of our GDP. So that's a huge component.
I don't know if you mentioned, did you mention, was there what's the evidence that wages are not growing? Is that just within the CPI?
It's part of the all the jobs reports that came out over the last week or two, and it shows that the wage increases have been very modest. They're not the way they were a year ago, 2 years ago, where they were just jumping quite rapidly. So that seems very contained as well.
So looks like the stock market responded well.
Stock markets responded well. S&P, again, I mean, it seems like just about every time we come on, I say that the S&P is, at an all-time high or very close to an all-time high. So again, same thing. I think as I saw the call today, it was about 10 points from hitting a new all-time high. NASDAQ is up 1.5% since we spoke last week. I mean, it's definitely a risk-on environment. You're seeing a lot of the tech names, race ahead again. So that's going on, on all this positive feeding into a narrative that, the economy is going to do well, companies will do well, all that kind of stuff.
On the other hand, the thing that we don't like about that is that is going to have an inverse relationship on bonds, right?
Exactly, because the bond market had actually been more pessimistic, right? So we talked about that, where rather than assuming that there's going to be a nice soft landing, bond markets have been a bit more nervous about an oncoming recession. We saw yields coming down to the mid 3% levels over the last week and for several weeks before that, which is nice because it brings down a lot of borrowing costs and that sort of thing. but they have moved relatively material back up. So the 5-year Treasury, the latest was at about 3.9%. If you compare that to about 3.5% last week, that's a pretty big move in a 1 week period of time. And the 10-year Treasury is up at 4%, and that was at 3.7% when we spoke last week. So that strong labor reading puts in doubt the the kind of more recessionary risk that the market was having.
So that's, like, from, just so that people understand, from the perspective of, and obviously, we have a ton of people in real estate on this show. For your houses, a lot of that is based on the 10-year Treasury. So that's kind of bad news for if you're in the housing market. But for multifamily, when you're talking about Freddie Fannie debt, like the non-recourse debt that we've typically used in our portfolio and that kind of thing, it doesn't really matter because the Fed rate is that's what SOFR follows, and SOFR is in line with the Fed, right?
Yeah. So you'll see that, despite that volatility in the Treasury markets, SOFR is at 4.85%, which is pretty much exactly in line where the Fed funds rate is, which is I think 4.83% last I checked. So it's spot on. It'll stay linked to the Fed rate, and as the Fed continues to cut its rate, SOFR will continue to come down as well.
Got it. All right. What else we got? I think you talked a little. We got gold and Bitcoin, right? Did you already?
Yeah. Well, gold actually, one of the few times we've actually said this, but it's actually down about 1% since we spoke last week. But it's still very, very close to its all-time highs. It's $2,640 per ounce. So it's holding up quite well. Bitcoin's trading in the low 60,000 level. So, not a whole lot of change there. But generally, I mean, I think it is right now an environment where I think people are taking more risk. They want to put their capital at risk so that they can get the returns, because the return potential is higher under the current circumstances.
Yeah, Bitcoin too. It's not really doing a whole lot. Now, I know sometimes we like to do some educational segments. We don't really necessarily have anything like that lined up today. But, one of the things maybe you could just mention is there's a lot of people who want exposure to Bitcoin. They haven't been able to because of this, since the inception of Bitcoin, it's really been there's been a technological wall as well. And then there's people who are not comfortable necessarily holding Bitcoin themselves. What are the different ways that people can get exposure to that if they want to?
Well, for the novice Bitcoin investor like myself, I mean, I prefer to go through an ETF.
Did you buy some?
For me.
Did you finally buy some?
I did get a little exposure in an ETF that has Bitcoin.
Which one?
I guess BTC, I think was the one. So listen, I don't know which way it's gonna go, but I just feel like if it starts jumping up high, I want to have a little bit of exposure here.
Sure.
So I'm not.
Well, I know you're not recommending.
I don't want to miss out.
I know you're not recommending it, and particularly as a wealth advisor, it probably gives you hives to start talking about Bitcoin. But I'm mostly just kind of thinking, like, if you've looked into any of the, what those ETFs
Yeah.
are.
I mean, listen, as a financial advisor, usually the way we handle, crypto is that it's the client themselves that comes and says, hey, I really want a little bit of exposure here. How should we build that into the portfolio? And so then it's an exercise more about, okay, let's think about what kind of risk appetite you have. How do we want to, what is it that we want to achieve with this exposure? And then we can build it and reflect that exposure the right way in an overall portfolio strategy. I mean, if someone comes to me and says, hey, let's build a complete crypto portfolio. I'm probably not your guy. I certainly don't know, the extent of other folks that are active in this market.
Yeah. All right. Well, we can leave it there. That was about a very lawyerly response on Bitcoin. Appreciate that.
Yeah.
So that's fine.
It's a tricky something.
All right.
Yeah. So you watch the Vikings game then?
I did. It was ugly. It was really ugly. But we still won. I mean, offense played terribly, but we're 5-0. We're going into the bye. I'm assuming you didn't watch because we won.
I was going to tell you, I did not watch, and that is exactly why they won. So.
Yeah. Don't watch for the next, I don't know, 6 months or so. We'll see what happens.
Wait till after the season, watch replay.
Yeah. I'm going to the Rams game. They're coming out here. It's a Thursday night game. So hopefully at least pull one out. Last time I saw the Rams, they got beat, but that was when Jared Goff was playing for the Rams, and he had the best game of his life. It was insane. But we'll see what happens. All right. Well, as always, it's a good conversation. Thanks for being on, and I'll catch up with you next week.
Thank you, Buck.
Thank you for listening to the Wealth Formula podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.